Hello students, welcome to Lokayan IAS Academy. Myself Saurabh Shirke. I welcome you to our Economy Insight series, in which we are going to discuss UPSC prelims previous year questions of Indian economy. Until now, we have discussed questions related to external sector and inflation. Now the topic of monetary policy is very closely related to inflation. So that's why we are continuing with monetary policy. Now in this lecture, we will discuss questions pertaining to monetary policy. First question. See, this question I had taken in previous lecture, but the visibility of this question wasn't very clear. That's why I am taking it again. In India, which one of the following is responsible for maintaining price stability by controlling inflation? Correct answer is Reserve Bank of India. We know about Monetary Policy Framework Agreement. Signed between Government of India and RBI. As per the agreement, it is responsibility of RBI to maintain the inflation between band of 4% plus or minus 2% CPI. Okay, 4 plus or minus 2% of CPI. If inflation falls below 2% or goes above 6%, then RBI will have to submit a report citing the reasons for this report on failure. So there is accountability mechanism, and RBI has to maintain the inflation taking into consideration growth also. So merely RBI shouldn't merely target inflation. It has to take into consideration growth and price stability. Growth and price stability. This question asked in 2022. So UPSC can extend its theme in upcoming prelim examination. That's why we discuss all these things. Okay, let's move to next question. In India, the central banks function as lender of last resort. Usually refers to which of the following? Lending to trade and industry. What is when they fail to borrow from other sources? Providing liquidity to the banks having temporary crisis. Lending to governments to finance budgetary deficits. Okay, now see, lender of last resort. This concept is properly mentioned in 12th macroeconomic NCERT. Okay, so why is RBI called as lender of last resort? First statement, lending to trade and industry. This is wrong. This is not within the ambit of lender of last resort. This is not correlated. First statement is wrong. Eliminate A. Second, providing liquidity to the banks having temporary crisis. Correct option. Third, lending the government to finance budgetary deficit. It's wrong. Answer is 2 only. Third statement is wrong. Third statement is incorrect. But let's discuss it in detail, because many times we have seen in a previous lecture also, UPSC repeats the themes or concepts mentioned in incorrect statements. So let's see why third statement is wrong. Financing budgetary deficit. See, from independence till 1997, being a socialistic economy earlier during Indira Gandhi's time, Jawaharlal Nehru, until 1970-1890, prior to LPG era, government used to have budget deficit. Even now also you have budget deficit, but the way to finance that deficit used to differ. See, till 1997, government used to finance the deficit through issuance of ad hoc bills, ad hoc treasury bills. Government used to issue ad hoc treasury bills and finance the deficit. So there wasn't any check on government's limit to borrow the deficits. So this gave rise to fiscal indiscipline. Fiscal indiscipline. The interest rates were also low. So the system wasn't financially feasible. So central government and RBI made an agreement, and from 1997 onward, system of ways and means of advances from 1997, through the system of ways and means of advances, temporary mismatch between revenue and expenditure was breached from 1997 onward. I think it's March 1997, just check. So under WMA facility, government can borrow from RBI to bridge temporary mismatches between revenue and expenditure, not to finance the deficit. See, what is temporary mismatch? Suppose government now has limited money for expenditure, but government know that after 2 months is going to get some money. So till now, our government can borrow from RBI under WMA facility to bridge the mismatch. Validity is 90 days. Interest rate is repo rate. And breaching this limit will convert the loan provided by RBI into overdraft with 2% extra interest rate. Okay, during ad hoc bills, interest rate used to be low. That's why government used to frequently finance the deficit by issuing ad hoc bills, which wasn't financially feasible. So the ways and means of advances, this system come up. Now also there is one provision in FRBM Act. FRBM 2003. This act we will discuss in our question series of budget and taxation. FRBM Act 2003 also mentions that government shouldn't finance their deficit by borrowing through RBI, but through the way of WMA, ways and means of advances. Okay, that's all about WMA. Important concept mentioned in incorrect statement. Okay, so we discussed it. Let's move to next question. See here, question from 2021 Civil Services Prelim exam. Governor of RBI is appointed by central government. Okay, certain provisions in the Constitution of India give the central government right to issue directions to RBI in public interest. The governor of RBI draws his power from RBI Act. First statement, Reserve Bank governor is appointed by central government. It's correct because governor is appointed by appointment committee. Which is obviously part of central government. First statement is correct. Second, certain provisions in the Constitution of India give central government power to issue directions to RBI in public interest. Now this statement is partially correct because not certain provisions of Constitution of India but section 7 of RBI Act. So whenever there will be word like provisions of Constitution of India, certain term is clearly defined in Constitution, you should pay more attention and just think whether this is a constitutional provision or some statutory provision. So here statement is wrong because not provision of Constitution but provision of RBI Act 1934. The governor of RBI draws power from RBI Act. Very generic, obvious statement, correct. So by eliminating 2, we get answer as C. So C, 1 and 3 only is the correct answer. Next question. Okay. Role of CRR, SLR. How does it affect money supply? Okay, prior to going our next question, let's discuss about expansionary monetary policy and contractionary monetary policy. Okay, expansionary monetary policy. What steps does RBI take during expansionary monetary policy? Like CRR, SLR. This statutory reserve requirements reduces. Plus more open market operations. Okay. These are the characteristics of expansionary monetary policy. See, monetary policy has two components, two types of tools, quantitative tools and qualitative tools. Go through them. Okay, because here we are not discussing in detail because we are discussing only that part which is important for solving our MCQ. Okay, this is expansionary monetary policy. Contractionary monetary policy. In contractionary monetary policy, interest rates increases. Okay, interest rate, CRR, SLR increases. Along with CRR, SLR, so repo. Okay, repo increases. Plus less open market operations. That's about contractionary monetary policy. So here you can see expansionary monetary policy, interest rate reduction. As interest rate reduces, borrowing becomes cheaper. As borrowing cheaper, more number of people can avail loans, so credit availability will be more credit availability, leading to more economic activities. This is expansionary monetary policy. Now contractionary monetary policy. Interest rate increases. As interest rate increases, borrowing becomes costlier. Borrowing becomes costlier, less credit is available because people cannot avail the loans easily. Less credit and low economic activities. Now, can you tell me in which circumstances a particular type of policy action can be taken? Say expansionary monetary policy. What we are doing through expansionary monetary policy, we are promoting economic activities. So expansionary monetary policy has to be taken during recession. So we in detail discussed about recession in our topic of inflation. Okay, and contractionary monetary policy, we are reducing money supply. So in which circumstance reduction in money supply is desirable? Obviously, when there is inflation in the market. To tackle inflation, contractionary monetary policy. Okay, so this is our foundation base for solving upcoming questions. See next question. Okay, if the RBI decides to adopt an expansionist monetary policy, which of the following would it not do? Expansionary monetary policy. Expansionary. So we have seen in earlier slide, what does RBI do? Expansionary monetary policy, it reduces interest rates. First option, cut and optimize statutory liquidity ratio. Correct. Increase the MSF, marginal standing facility rate. This is also one of the tool of monetary policy. Wrong one. Cut the bank rate and repo rate. Correct. But what is asked? Which action will it not take? So option is B, 2 only. Okay. Expansionary monetary policy. Okay, this one is very important and conceptual question. So pay attention, do not write anything, see and understand the concept. Which one of the following is not the most likely measure the government RBI takes to stop the slide of Indian rupee? Okay, we have solved MCQs regarding rupee depreciation in our first lecture. So, what is the scenario during rupee depreciation? Let's discuss that. Sliding up, there is slide in rupee. Rupee depreciation. $1 earlier used to be 60 rupees. Say now is 70 and depreciating further. There is more slide. Now, what is the key characteristic of this situation? That is, there is shortage of dollars. shortage of dollars. The demand of dollar is greater than supply of dollar. So to prevent the further slide, what we have to do? We have to prevent further slide. We have to increase the demand of dollar. Sorry, wrong. We have to reduce demand and increase the supply. This we have to do. So now, okay, we have to stop this further sliding of rupee. Let's go statement by statement. First one. Curbing imports of non-essential goods and promoting export. Okay, so by curbing non-essential imports, we have reduced a dollar payment, and by promoting export, we have increased our dollar earning because we will export the things and earn dollar. First one is correct. Encouraging Indian borrowers to issue rupee denominated masala bonds. See, this keyword is important. Rupee denominated means the bonds will be denominated rupee, not in dollars. What is the characteristic of masala bonds? They are issued in overseas market. Refer 2016 question. I think 2016 or 17 question regarding masala bonds. So what do we need to do? So masala bond is denominated in rupee. So dollar of demand won't be increased. This one is also correct option because see here we have to reduce the demand, okay, not increase. Third option, easing conditions relating to external commercial borrowings. Correct answer because see here what we have to do, increase supply of dollar. So how the supply of dollar will be increased? By easing the conditions related to ECB, external commercial borrowings. When the conditions will be eased, the borrower will find it more easier to take loans. The dollar supply will increase. Further sliding of rupee will be stopped. So this one is also correct. So obviously only one option has remained, so it has to be wrong. So fourth option, following an expansionary monetary policy. This one is wrong option. But let's understand why this option is wrong. Because understanding concept is important. See, following an expansionary monetary policy. See how many times this keyword is repeated. In 2020 we saw expansionary monetary policy implications. Now this. That's why I explained in our previous slides this contractionary monetary policy, expansionary monetary policy. In our lectures of budget and taxation, we will often encounter words like counter-cyclical fiscal policy, pro-cyclical fiscal policy, fiscal stimulus, fiscal consolidation. We should be aware of the basic meaning of these terms. Okay, now see, let's understand why this measure is not most likely to be taken. As the question states, not the most likely measure. So let's discuss. Sorry. Okay, let me repeat. Expansionary monetary policy. So interest rates will be reduced. So more credit availability, more credit means more rupee in market. As per demand supply law, more the rupee in the market, its value will further depreciate. So more rupee. Further depreciation. Also, in expansionary monetary policy, we will reduce our interest rates. So, as interest rates will be reduced, will the foreign investors have any incentive to invest in Indian economy? No, because interest rates are low. So, they will try to find some new location to invest. So, this will reduce our capital inflow. Reduce our capital inflow. That is incoming of dollar. So dollar supply will be reduced. So overall rupee will depreciate further. That's the reason why this is the most unlikely step. Understood? See, understanding the incorrect statements is also very important. Okay, let's move to next question. Okay. The Reserve Bank of India's recent directive relating to storage of payment system data, popularly known as data dictate command payment system, provides that they shall ensure that entire data relating to payment system operated by them are stored in system only in India. Mark this keyword. Okay. They shall ensure that the systems are owned, operated by PSUs. Okay. They shall submit the consolidated system audit report to the CAG by end of the calendar year. Now, this data dictate was in news and widely discussed. Okay. During that year's economic survey also it was mentioned that data is the new oil. So obviously, see the first statement, they shall ensure that entire data relating to payment system operated under them is to be stored in India. This one is correct statement because fintech companies have very sensible data regarding our financial transaction. So it is not desirable that it is stored in US servers or any other foreign country servers. So this statement is correct. Now, before going to second statement, let's discuss third one. They shall submit the consolidated system of audit report to CAG by end of calendar year. Is it possible? Just think about what are the duties of CAG. What is the constitutional mandate? So will government make such provision that these fintech companies like or payment gateways, Visa, MasterCard, have to submit audit report to CAG and CAG to verify it? Very unlikely. Eliminate 3 gone. Now A or B, 1 or 2. They shall ensure that systems are owned and operated by public sector enterprises. See, this is very cutting edge technology, storing of data and all that infrastructure. So just think whether our PSUs have that much technical competence. I'm not criticizing PSUs etc., but just think if they have that technical competence and that much infrastructure, and what is the trend? There is disinvestment going on. Government has set target of 1 lakh crore every year. So very unlikely that such infrastructure, such data will be stored by PSUs. So eliminate this. Option A is the correct answer. 1 only. Let's move to next question. Okay, which of the following statements correct regarding Monetary Policy Committee? Very recent development. Okay, it decides RBI's benchmark interest rates It is a 12-member body including governor of RBI and reconstituted every year. It functions under the chairmanship of Indian Finance Minister. Okay, see, RBI Monetary Policy Committee. Monetary Policy Committee decides on key policy rates to maintain the inflation within the bound of 4 plus or minus 2% of CPI. Third statement, it functions under chairmanship of finance minister. It's wrong because it functions under chairmanship of RBI governor. Second, it is a 12-member body. Wrong statement because Monetary Policy Committee is 6-member body. Six-member body, governor, deputy governor, member nominated by Central Board of Directors of RBI, and 3 government nominees. So second statement is incorrect, third one is incorrect. Eliminate. First one only is correct answer. It decides RBI's benchmark interest rate. Obviously correct statement. Sorry. Let's move to next question. Okay, very important topic. What are the purposes of marginal cost of funds based lending rate? Okay, prior to discussing this question, let's discuss MCLR, base rate, etc. Okay, before that, let's discuss monetary policy transmission. See, RBI has mandate to control inflation within the bound of 4% plus or 4 plus 2 or 4 plus or minus 2% of CPI. So for that, RBI has to take various steps. Suppose there is inflation in the market. Inflation in the market means what? There is excess money supply. So to tackle this inflation, what RBI has to do? Reduce the money supply. Reduce money supply. So for that, what RBI has to do? Increase interest rates. Okay, now consider second situation. There is recession. Recession going on in the economy means what? Economic activities are low. So what RBI has to do? It has to make sure that there is sufficient credit available. So it has to increase credit availability. Credit availability. So for that, RBI will reduce the interest rates. This is contractionary monetary policy. This is expansionary. Now suppose consider a scenario for tackling recession. RBI has reduced interest rates so that banks will take loan at lesser interest rate. As their cost of borrowing has reduced, obviously they will extend it to retail customers like us or any other business and etc. who are taking loans from bank. But suppose this reduction in transmission from RBI is not transferred to the customers, then what? Then that is the ineffectiveness of monetary policy transmission. So what is monetary policy transmission? How the rate reduction or rate increase from RBI is going to the bottom to till customers. This is monetary policy transmission. RBI, then bank, whether this is percolating to customers. This is monetary policy transmission. Now let's discuss various rates regime. Okay. Earlier there used to be benchmark prime lending rate. Under benchmark prime lending rate, bank board of that particular bank had full autonomy to decide the interest rate. To decide interest rate, but this system has certain inefficiencies, like often few unworthy customers got loans at very cheaper rates and cost to common borrowers. So to remove the deficiencies comes base rate regime. Base rate. So base rate plus spread is equal to interest rate. Spread means margin of the bank. Base rate determined on cost of funds, operational expenses, interest rate on saving, interest rates on deposits. These are the major components used to determine the base rate. This is not exhaustive list, I am giving you indicative list. So upon this, interest rate of bank for lending loan used to be decided. Now there were deficiencies in this system also, because it didn't consider repo rate not considered. So whenever RBI used to reduce repo rate or increase repo rate, there wasn't any significant effect on the base rate. Also, no frequent revision, no periodic revision of base rate, when to change and etc. Revision. Okay. So to tackle this comes MCLR in 2016. Change the width. MCLR also had similar components like cost of funds, CRR, SLR, then interest rate, but it also has repo rate while determination of MCLR. So it was better, and it has monthly revision. We will see in next slide. But still, various government documents like economic survey, budget mentioned that the monetary policy transmission wasn't effective even under MCLR. So we come up with external benchmarking now. Question hasn't asked yet until the question hasn't asked on external benchmarking. So under external benchmarking, RBI gave 4 options. First one is repo. Second is yields on treasury bills 91 days, yields on treasury bills 182 days, or any benchmark of FBIL, Financial Benchmarks India Limited. Okay, this is external benchmarking. Let's see in detail. See what RBI is saying. See RBI Governor statement. It was time to formalize an external benchmark in lending for effective transmission of policy rates. Okay, MCLR hasn't been satisfactory, says RBI. Okay, see the linking. Loans can be linked to repo, 3-month or 6-month treasury yield, or any FBIL floated benchmark. This is MCLR linked to bank's cost of funds. See, takes 4 to 6 months to move after RBI cut rate. RBI rate cuts not fully passed on to borrowers. Resets annually for most of the banks. Changes by 5 to 10 basis points. Revised every month and low volatility. Now this repo linked loan will have higher volatility. Why? Because repo rate, if it is linked to repo, suppose in monetary policy meeting, RBI decides, taking into consideration the situation, to reduce repo or increase repo, the rates of loan will increase with that effect. So it has higher volatility. Because along with repo, it also has other components. So volatility wasn't that much like it has in this system. Okay, this is all about base rate, BPLR, MCLR and external benchmarking. External benchmarking is very important. Upcoming prelim. Let's solve the question now. These guidelines help improve transparency in methodology for banking and determining interest rates. Correct statement. These guidelines help to ensure availability of bank credit at interest rates which are fair to borrowers as well as to bank. Correct. Correct answer 1 and 2. This is all about how interest rates determined. Okay, let's move to next question. Take screenshot of this and read. Okay, with reference to Indian economy, consider following: bank rate, OMO, public debt, public revenue. Which of the above components of monetary policy? You can refer any static book. There you will read about quantitative tools, qualitative tools. Okay, clearly bank rate and OMO are tools of monetary policy, not public debt or public revenue. These are related with fiscal policy. So option C 1 and 2 is the correct answer. Next question. When Reserve Bank of India reduces statutory liquidity ratio by 50 basis points, which of the following is likely to happen? Okay, India's GDP growth rate increases drastically. FII may bring more capital into our country. Scheduled commercial banks may cut their lending rates. It may drastically reduce liquidity to the banking system. Let's eliminate first wrong answer. SLR reduction means which policy? Expansionary monetary policy. SLR has reduced, so banks have more money to lend. So it may reduce liquidity to the banking system. Very incorrect statement. Eliminate. India GDP growth rate increased drastically. See, SLR reduced, more creditability, more economic activity. So GDP will improve, but will it improve drastically? No. This keyword makes this statement wrong. So incorrect. Foreign institutional investor may bring more capital into our country. This is a very vague and far-fetched statement. So we will not consider this. See, scheduled commercial banks may cut their lending rates. This one is correct. So make habit of negating the statements also. Reason behind it. This will help you in actual examination. Next question. The terms marginal standing facility rate and NDTL sometimes appearing in news are in relation with. Very simple question. It's banking operation, not communication networking, military strategies and supply and demand of agricultural products. This question was asked in 2014, but currently UPSC do not follow this trend. But what we have to do, we have to understand the terms. What is the difference between MSF and repo? See, under repo, reverse repo, banks sell securities. Repo and reverse repo. Securities which aren't part of SLR. Okay, and under MSF it is marginal standing facility. Securities sold are part of SLR. The CRR is in cash, but SLR cash, gold, government securities, etc. So when security under this is sold, this is MSF. It has higher rate, higher interest rate than the repo. Okay, so A is the correct answer. Next question. In the context of Indian economy, which of the following purpose of statutory reserve requirements? To enable the central bank to control the amount of advances the banks can create, to make people's deposit with bank safe and liquid, to prevent commercial banks from making excessive profits, to force the banks have sufficient vault cash and to meet day-to-day requirements. Eliminate most incorrect statement. Third statement, to prevent the commercial banks from making excessive profits. Very illogical and vague statement. Eliminate. Fourth statement automatically got eliminated. Force banks have sufficient vault cash to meet their day-to-day requirement. For that we have different provisions. Now see, second statement, to make people deposit with banks safe and liquid. Now to make people's deposit with banks safe, we have capital adequacy ratio. Under Basel norms, we have provision of capital adequacy ratio. Okay, and liquid. See, statutory reserve requirements comprise of CRR and also SLR. SLR has gold and G6 also, government securities. So second is also incorrect. First, to enable central bank to control amount of advances banks can create. This one is correct. So one is correct. The first statement is correct because RBI can control the advances which bank can control, the amount of advances which bank can create, because this is RBI does this to either control inflation or to tackle the recession. Okay, first statement is correct. Next, the Reserve Bank of India regulates commercial banks in matters of liquidity of assets, branch expansion, merger of banks, winding up of banks. Correct answer. Liquidity of asset, we have reserve requirements. Correct. Branch expansion, correct. RBI has issued various circulars regarding branch expansion. Merger of banks, correct, because RBI approval is needed. Winding up of banks, also correct. 1, 2, 3, 4 is the correct answer. Let's move to next question. In the context of Indian economy, open market operations refers to, very easy question, directly mentioned in 12th macroeconomics NCERT. Topic on RBI. Correct answer is purchase and sale of government securities by RBI. This is correct option, correct statement. Question is asked in 2013. Now UPSC generally doesn't ask such a simple question. Yes, it does ask, but on previously asked topic, it doesn't ask this much simple question. So what we will do now, we will discuss one important theme, very important theme regarding open market operations. That is Operation Twist. Few years ago, RBI for the first time conducted Operation Twist in Indian market to reduce the bond yields on long-term government securities. So we will discuss Operation Twist. But prior to that, let us discuss relation between bond price and bond yield. Because in earlier lecture, in lecture number 1 or 2, I clearly stated that, bond price is inversely proportional to bond yield. Didn't explain you that. So I told you just remember that relation. But first discuss that inverse relation. Because if you understand the relation, then things will become much easier. Okay, let me erase this. Okay, what is the bond yield? I will explain you through example. Suppose there is bond worth rupees 100, maturity period 1 year, interest rate 10%. So how much will I get after a year? Rupees 110. This 10 rupees, nothing but the yield. There is a yield on bond. Now consider this scenario. Let's discuss the relation between bond price and bond yield. Suppose there is bond worth, same example, bond worth rupees 100 and interest rate 10%. Now consider the demand for bond due to various market reasons increases, and I sell that bond to someone else. Now the price has increased due to increase in demand. It become 105. Now, though the current value of bond is rupees 105, the face value is rupees 100. So after 1 year, the new bond holder will get 110. So the actual interest rate he is getting is less than 10%, because what he is getting 102 extra 5 rupees instead of extra 10 rupees which I would have got. Now suppose there is lack of demand, so I have to sell that bond for rupees 95 rupees. Now the new purchaser, there is new bond holder, will get 110 rupees because face value is rupees 100 and interest rate is 10%. So obviously the interest rate that he will have is more than 10%. Sorry, this is less than. More than 10%. Here yield is maximum. Okay, here it's getting rupees 15. And here rupees 5. So what the relation we can derive? See clearly, whenever there is increase in bond price, yield is reducing, and whenever there is decrease in bond price, yield is increasing. So bond price inversely proportional to bond yield. This is the core relation. Okay, now before understanding operation twist, let us discuss what are the impacts of high bond yields. Okay, high bond yield. See why I am discussing this topic in detail, because for 2 successive years in 2021 prelim and 2022 prelim, question on bond yield has been asked. Okay, high bond yield makes government borrowing costlier. This is one of the disadvantage. And see, in economy, whenever there will be high yield on government bonds, then there will be more demand to have more yield on corporate bonds also. So yield on corporate bond also increases. So this is not good for economy or good for economic activities. So it affects corporate bonds also. Also, yield on long-term government securities, 10-year government security, directly linked with long-term lending rate in the market. So that also increases with increase in yield. Okay, long-term interest rates, which is not beneficial for improving economic activities. So this is another disadvantage. Okay, so our foundation base is clear. You understood relation between bond price and bond yield and negative implications of higher bond yield. Now discuss operation twist. Operation twist. 2 simultaneous operations. First one is selling short-term government securities. And second operation, purchasing long-term government securities. worth same value. If I am selling short-term government securities worth 10,000 crore, then same amount of long-term securities government has to purchase. Okay, see, selling of short-term government securities in market. So what will it do? First discuss this purchasing of long-term government securities. Supply of long-term government securities will reduce. So as supply will reduce, the value will increase. Reduction in supply, increase in value, law of demand and supply. Bond price will increase. We have seen bond price is inversely proportional to bond yield. So bond yield will reduce. This is the main motive behind operation twist, to reduce the yields on long-term government securities. Selling short-term government securities. What will happen? More short-term government securities in market. So bond price will reduce, resulting in increase in bond yield. See why reducing yield on long-term government security is important? Because I had told you that long-term interest rate loan in the market is mainly determined by this long-term government security yield. That is the core purpose of operation twist. So remember this. There is a high possibility UPSC will ask question on operation twist. Okay. An increase in bank rate generally indicates that market rate of interest is likely to fall. Central bank is no longer making loans to commercial banks. Central bank is following an easy money policy. Central bank is following tight money policy. We have studied this in expansionary monetary policy and contractionary monetary policy. Even if you forget, then also observe the pattern of statement C and D. Central bank is following easy. Central bank is following tight money policy. Exactly opposite statement. One has to be correct. So increase in bank rate, contractionary monetary policy. That is also tight money policy. D is the correct answer. Okay. Reserve Bank of India acts as bankers' bank. This would imply which of the following? Other banks retain their deposits with RBI. RBI lends funds to the commercial banks times of need. RBI advises commercial banks on monetary matters. All these statements are correct. 1, 2 and 3. Okay. Next question. Lowering of bank rate by RBI leads to more liquidity in the market, less liquidity in the market, no change, and mobilization of more deposits by commercial banks. Again, observe the pattern of statement 1 and 2. More liquidity, less liquidity. Okay, bank rate is reduced. Question number 17. Lowering of bank rate by RBI leads to bank rate has reduced. Okay, there will be more credit availability, more liquidity in the market. First one is correct. See, now observe statement number question number 15 and the 17. Similar in nature. Okay. Now last question. In India, government bond yields influenced by which of the following? Actions of United States Federal Reserve, actions of RBI, inflation and short-term interest rates. All are correct. We have solved this question in our earlier lecture, but as I said in that lecture that we will discuss this option in detail in our lecture of monetary policy. So let's discuss how actions of Reserve Bank of India influence bond yields. Okay, no space. Okay, suppose RBI is following expansionary monetary policy. Expansionary monetary policy, interest rate reduction, cheaper loans, more credit availability, bond price increases. As bond price increases, yields reduce. Reduction in yield. Now, contractionary monetary policy. Interest rates increases, costlier borrowing, less credit availability, so prices will reduce. And yield, this is the relation between expansionary monetary policy and bond yield and contractionary monetary policy and bond yield. Having clear-cut conceptual clarity regarding these concepts very important for solving questions relating to Indian economy. This is all about the lecture. So go through the question and solve again. If you like the video, please like, comment and subscribe our channel. Thank you very much for watching the lecture. बंद नहीं, हाँ कर।